Inflation is not coming down, and yet the Federal Reserve is starting to lower their interest rates. Hey everybody, hope you're doing great today. This is Paul from This Way to Prosperity. Let's take a look at inflation today and where it's at and what the Federal Reserve is doing in terms of their interest rates. So while inflation has come off its recent highs, it still remains elevated. The common phrase thrown around in the media is disinflation, which is to imply that there is deflation when in fact there is not deflation. Disinflation just means that the rate of inflation is lower than it was in the past. So there's still inflation. A lot of consumers are still suffering from higher costs, higher expenses, and it's pinching their budgets in many different ways. So let's take a look at this recent report here from the Bureau of Labor Statistics. So this report was released November 13th, 2024, and they discussed the Consumer Price Index for October 2024. They note the Consumer Price Index for all consumers increased 0.2% on a seasonally adjusted basis in October of 2024. This is the same increase as in each of the previous 3 months. So overall, the last 12 months, all items index increased 2.6% before any seasonal adjustment. Shelter in particular rose 0.4%. Food also increased 2%. Energy was unchanged for the month of October. So overall, we're looking at 2.6% for the 12 months ending in October, which means inflation is still higher than normal. In fact, I would argue 2% inflation is an arbitrary number. Whether we need inflation or not is another story. Inflation definitely hurts the lower end consumer, unless they're getting raises, in which case many are not, especially with your senior citizens on fixed income or those working a fixed wage where they're not expecting any annual increases. Inflation eats away at their budget, causing them to spend more and earn less over time. One of the Federal Reserve persons in the past in a country other than the US stated 2% is a good rate of inflation to have. They never provided any reasoning for that, any basis for that. They just said, hey, let's go with 2%. And every central bank seems to have adopted that as a policy for their own monetary systems. Any inflation is harmful for the low-end consumer, for fixed income consumers. So for those on fixed income retirement plans, or they are in a job where they don't see many raises year over year, that 2% inflation slowly degrades the value of their purchasing power, their budgets, so they're spending more while not necessarily earning any more. So even with inflation where it's at, the Federal Reserve still continues to do their quantitative tightening, whereas versus earlier they were doing quantitative easing, but at the same time too, they've decided to reduce the federal fund rates. So in September they reduced by 50 basis points, and just in October they reduced by 25 basis points. So according to the Federal Reserve, the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Basically that they feel inflation is where it should be and the employment is stable. So they're concerned about having rates too high for too long. They want to start reducing those rates. But whether that's in time to prevent any recessions, prevent any other issues, is another story for another video. Here's an article from investment bank Goldman Sachs discussing whether the U.S. consumer is losing spending momentum. So they note some recent consumption data has appeared soft. Real personal consumption expenditure rose to 2.6% in April from the same month a year ago, compared with a pace of about 3% last year. So basically you're seeing a slowdown in spending. Nominal retail sales increased just by 0.1%, while spending prior months was revised down. So this chart shows the real income growth forecast for 2024, and as you can see, it's predicted to go down overall to 2.5%, whereas inflation currently is running at 2.6%. That means people are getting in less compared to the rate of inflation. So they do note that household balance sheets are in good shape, basically because of the increase in home values, which I would argue that the increase in home values happened as a result of improper monetary policy. Basically, a lot of free money during the COVID pandemic era, very low interest rates by the Federal Reserve, and the Federal Reserve purchasing MBS, mortgage-backed securities, in order to reduce mortgage rates, resulted in a free-for-all of buyers going out, bidding up homes, multiple offers, prices went through the roof, and governments want high home prices because then they can increase their property taxes, increase their tax receipts from those property taxes, and that's a big benefit for governments all around. So the free market incentive is not necessarily something that the government pursues when it comes to housing pricing policy. The article also notes that the lower-end consumer is facing more difficulty. They talk about publicly traded consumer companies tend to skew more towards the lower-end households, and they're the ones suffering, so those companies are also seeing some results from these consumer spending where it's not as beneficial towards their bottom line. Well, elections are now over. High inflation represented one of those big items that both candidates had to address. In my opinion, regardless of who had won, the next president is going to be facing a lot of headwinds when it comes to managing the economy. We're looking at decoupling with China because of policies within the US, reshoring manufacturing, shortage of available housing inventory, and workers looking for higher wages in order to counter inflation. So there's going to be a lot that needs to be done in order to reshore those factories, and what that's going to result in is an increase in costs and expenses for individuals as well. So I think inflation will go higher regardless of who is president. In this case, we do know who's going to be the president. The policies the next president implements are going to have an impact, especially when we start bringing back manufacturing to the United States. It's going to mean building more factories, taking away resources from one part of the economy in order to build that up. So in the interim, that's going to cause an increase in the rate of inflation, especially as we decouple with China. A lot of the important supplies and materials that we get from China will not be available. In the past, the inflation was exported to China. They were able to produce goods for much cheaper than we could here in the US. Now, as that turns about, building up those factories, building up manufacturing is going to take some time before we get to a scale where we can do it as efficiently. I don't know that we're going to be able to do it as cost effective as the Chinese have been in the past. So one of the ways the Federal Reserve attempts to control inflation is by control of the federal funds rate, basically the interest rate that they charge for banks to borrow money from the Federal Reserve. By dropping that interest rate, increases the incentives for banks to borrow more money from the Federal Reserve, lend that money, which can result in increased inflation, all other things being equal. So it remains to be seen what these recent interest rate reductions by the Federal Reserve will result in. It takes a couple of months before the rate reductions start to be felt in the economy. So next year, as the new president takes office, inflation may start to increase because of the cheaper availability of funds. While it's not close to zero where it was in the past, it's still lower than it has been in the recent times. So we'll see where it goes with the economy in a couple of months. That's all I have for this video. If you found this to be helpful and informative, please hit that like button so others can find it too. Thank you for watching, and I'll see you in the next one.